This is a continuation of the FASB conceptual framework. In particular, we're going to be talking about assumptions, principles, and constraints underlying generally accepted accounting principles and the conceptual framework. So if we go to our first slide, we see our overall view of the FASB conceptual framework, and we are now going to concentrate on the last three categories here at the bottom of the conceptual framework, and that includes underlying assumptions, accounting principles, and constraints. What makes these a bit unique is that these are born from the accounting traditions and practices of accounting over the years. So these help reaffirm some of the traditions accountants have upheld over the years. The first thing we're going to do is we're going to look at underlying assumptions. So the assumptions underlying generally accepted accounting principles. The first assumption is what we call the entity assumption, and that means an entity, that economic entity that we're accounting for, it stands on its own. It stands on its own and it's separate and apart from its owners. In other words, all assets and liabilities, revenues and expenses are identified with the entity. None of that is commingled with that of its owners. Number two, we talk about the going concern assumption. And what that means is, absent to any contrary information, it is anticipated that the entity itself will operate indefinitely. And you can see why that's important, because if we thought that the entity was going to basically cease operations during the year and the following year, we would have to start valuing assets and liabilities at liquidation value rather than going concern value. The periodicy assumption is basically the division of time into artificial periods, and those artificial periods are typically months, quarters, or years, but it can be any type of division that you want. And the reason we do this is because in order to have useful information, one of the most important attributes is basically the timeliness of information. So in order to provide timely information, we have to split the life of an entity into these artificial time periods. The last assumption is what we call the monetary unit assumption. And the monetary unit assumes that we have to have a common denominator in our financial statements, and that common denominator of reporting is the US dollar. Also, the value of the dollar is assumed to be relatively stable over time. Now we know the value of the dollar changes with time, but it doesn't change that much that we can't have comparability between today and the financial statements from 2 or 3 years ago. Now we're going to go on and speak about accounting principles, and the first principle we're going to talk about is the cost principle. Now this is an in general principle, and what that says is that the cost principle, and I should take the word GAAP, but it should say the cost principle basically measures transactions by their original transactional value. That's when we have a willing buyer and a willing seller. That's a very objective measure of value at that particular period of time. But we've also learned from our foray into recognition and measurement that besides cost, there's 4 other general measures of there's 4 other ways of measuring costs and assets and so forth. So in general, the cost principle still stands, but there are other ways of measuring values. We also have what we call the realization principle, and the realization principle pertains to revenue in this case, and it says the realization, in fact revenue, occurs when goods or services have been exchanged for cash or for claims to cash. This should sound familiar from our recognition and measurement video. Also, realization occurs when the earnings process has been substantially completed and the entity is entitled to receive the resulting benefits or revenues Also, there's a reasonable certainty as to the collectability of the asset to be received. So that's the general realization principle, although it has been heavily modified because of issues regarding revenue realization with the Securities and Exchange Commission and the accounting profession in general, the manipulation of revenue recognition. We also have the matching principle, where basically expenses should be recognized or matched in the same period to the revenues that they help produce. The last accounting principle is what we call the full disclosure principle, and that is any information that could change the decisions made by the stakeholders should be provided in the financial statement, of course subject to cost constraints, and these are typically provided in what we call in the financial statements in parenthetical comments, in disclosure notes to the financial statements, or most people call them notes to financial statements, and or supplementary financial statements. Okay, with that in mind now, let's go on to constraints of generally accepted accounting principles, or constraints within the framework. And we've reviewed some of these before, but we're going to go over them again. But we have four major constraints. The first one is materiality. And what that means is information is material. It should be disclosed either in the financial statements or the notes. If it's material, only if it affects the decision usefulness to the stakeholders. So if something is not material, it's not going to affect the decision usefulness of the stakeholders. So we really don't need to include that information if we don't want to. Cost effectiveness. The benefit of information in decision usefulness to the stakeholder should exceed the cost of producing it. Next is conservatism, and what that means is, given two or more accounting treatments, the preferable treatment is to recognize a transaction that produces the lowest amount of net assets or the lowest net income. And lastly, we have this constraint called industry practice. And industry practice are traditional practices that may go against other accounting principles or go against some of the underlying concepts, the FASB accounting concepts, but they've been practiced within the industry so long that to change them would harm the comparability between the time it was changed in the past times. So with that, we have two multiple choice questions, that the type of questions you could see on the CPA exam. So let's take a look at question number one. Number one, what is the underlying concept governing the generally accepted accounting principle pertaining to recognizing gain contingencies? Again, stop your video, and when you're ready, start it up again to see the answer slide. Number one, what is the underlying concept governing the generally accepted accounting principle pertaining to recognizing gain contingencies? And the answer in this case would be A, conservatism. And if we take a look under constraints, under conservatism, given two or more accounting treatments, the preferable treatment is to recognize a transaction that produces the lowest net assets and or the lowest net income. And here we're given a decision between two different accounting treatments, either to recognize a contingency or not recognize a contingency. And by not recognizing that gain contingency, that is going to result in lower net assets and or the lower net income. So conservatism could govern that. If we take a look at B, which is relevance, relevance relates to the capacity of the information to really impact the decision usefulness. C, consistency, that refers to the consistent application of an accounting principle. Is it being applied consistently every accounting period? Okay, then D, faithful reputation, and that's a qualitative characteristic, and it's useful information. It's useful information that represents the economic events it purports to represent. So it really doesn't pertain to recognizing gain contingencies. Let's look to question number 2. Question number 2, the following accounting concepts are most likely associated with the matching assumption. So which concepts are basically most likely associated with matching the matching assumption? Again, stop your video. Okay, and the answer in this case is going to be D, deferred expenses, and let's go through every one. Okay, the first item is which concept are most likely associated with the matching assumption, and A, depreciation. Now, depreciation is really a systematic allocation of cost over the service period of the asset. So it's really not matching expenses totally to revenues. It's doing it on a systematic basis. In the case of B, accrued revenue is where revenue has been realized and recognized, but the matching principle matches expenses to revenues. It doesn't match revenues to expenses. And then unearned revenue, it's similar to B. It's in effect where cash has been collected but it hasn't been realized yet, so it's recognized, we record it, we recognize it as a liability. Again, the matching principle matches expenses to revenues, not revenues to expenses. So we look at D, and that's deferred expenses. For some reason these expenses are being deferred, and the most likely case is the expenses are being deferred because they're going to be recognized in the same period of the revenues that they help produce. So that's the end of our FASB conceptual framework video. Thank you for your time.